me ask you a question. What do stocks have in common with volcanoes? Well, they both erupt, one with molten lava and the other with cash flow. Let's look at the money side. How much money would you have if you invested $20,000 today at 10% interest per year? Or if you invested $1,000 today at 10% per year? Well, let me tell you something. The answer depends on one thing: compounding. And this is also the power behind the cash flow erupting stocks. Hello and welcome back to Fun Financial Insights, the channel where we make complex financial terms and numbers entertaining and easy to understand. Today we're going to talk about one of the most powerful concepts in financing: compounding. Compounding is the process of earning interest on your principal amount as well as on the interest portion year after year. In other words, it's interest on interest. Sounds simple, right? But you'd be surprised how much difference it can make over time. Stay tuned because in just a little bit, I will show you strategies you can use to leverage compounding for your stock portfolio. But first, let's understand compounding practically. Let me show you an example. Suppose you have $10,000 and you invested in a savings account that pays 5% interest per year. How much money would you have after 10 years? If you use simple interest, which means you only earn interest on your original amount, you will have $15,000. That's not bad, but it's not great either. But if you use compound interest, which means you reinvest your interest every year, you will have $16,288.95. That's more than $1,000 extra just by letting your money work for you. And that's not even the best part. The longer you let your money compound, the faster it grows. After 20 years, you will have $26,532.98. After 30 years, you will have $43,219.42. And after 40 years, you will have well over $70,000. That's 7 times your initial investment without adding any more money. Now, you may be thinking, well, that's nice, but who has 40 years to wait? Well, you don't have to wait that long to see the benefits of compounding. You can speed up the process by choosing the right strategies to build your portfolio. A lot of things in life depend on supply and demand, and stocks are no different. When there is high demand with low supply, the price increases. And when it's the opposite, the price reduces. While selling or buying as well, the goal is to always make a profit. Now, how can we leverage simple ideas like this to choose the right stocks? Well, let's look at 3 ways to leverage compounding. But first, if you're enjoying this video and finding it helpful, be sure to hit the subscribe button for more fun and insightful episodes just like this one. Number 1, choose stocks with high ROIC. The goal of every business is to make a profit. ROIC, return on invested capital, measures how much money a company can make on its money. Simply put, it is the percentage profit or return the company is able to get on an amount of invested capital. For example, if you had $100 and were able to turn that $100 into $2 in profits, you'd have an ROIC of 2%. The formula for ROIC is net operating profit after tax divided by the invested capital. Research has suggested that companies with high ROICs tend to have higher valuations in the stock market over time. This is because the stock market recognizes these companies' superior ability to grow with less capital, which makes it easier for the company to grow in the long term. High ROIC companies are usually compounding machines. They compound their own capital and that of their investors very well. Some examples include Apple, AutoZone, Domino's Pizza, Fortinet, MasterCard, O'Reilly's Automotive, Starbucks Corporation, Ulta Beauty, and VeriSign, just to name a few. Most of these companies have an ROIC greater than 50%. You can also use tools like finviz.com or quickfs.net to check the ROIC of the stocks you want to invest in. Number 2, companies that have a history of stock buybacks. Another thing to look for when choosing stocks that will help you compound easily is stock buybacks. Stock buybacks are when a company uses cash to buy back its own shares from the market. Why would a company do that? Well, there are several reasons, but one of the main reasons is to increase the value of its remaining shares. Here's an example. Suppose you own 100 shares of Company X at $10 each. That means your investment is worth $1,000. Now, suppose Company X decides to do a stock buyback and offers $12 per share for its own shares. That means you can sell your 100 shares for $1,200 and make a profit of $200. But wait, there's more. If Company X does this regularly over time, it will reduce the number of shares outstanding, that is, the number of its shares available in the market, by 10%. Due to the reduced supply, this increases the value of the company's shares in the market, as the remaining ones are bound to have more demand. By buying back shares, the company is paying off investors and reducing the overall cost of capital, especially if they offer dividends. But how does stock buybacks affect compounding? Stock buybacks can boost compounding in two ways. First, it increases the earnings per share, EPS, of the company. EPS is calculated by dividing the net income by the number of outstanding shares. When a company buys back its own shares, it reduces its net income but increases its EPS because it has fewer shares outstanding. And second, it increases the market value of the company's remaining shares. When a company buys back its own shares from the market, it signals that it believes their shares are undervalued or have more potential than other investments. This increases the demand for those shares and drives up their prices. By increasing EPS and market value, stock buybacks can make your investment grow faster over time because you are earning more returns on both sides, from capital gains, if any, and from dividends, if any. I will talk about dividends too soon, so keep watching. Apple, for example, has led all companies in the S&P 500 in the amount spent on share buybacks. In 2021, Apple spent a total of $85.5 billion on share repurchases and $14.5 billion on dividends, as its market capitalization briefly touched $3 trillion in 2022. You can use tools like ycharts.com to track stocks' buyback history or other stocks you are interested in before investing in them. Number 3, companies that use cash flow to pay dividends. Dividends are like interest payments on your investment, but they are usually paid quarterly or annually instead of monthly or yearly. Why do companies pay dividends? By paying dividends, companies show that they appreciate their shareholders' support and trust, and they have confidence in their future earnings. Your dividend-paying stocks can be a source of passive income, but instead of spending them, the way to leverage the power of compounding is to put the money back into your portfolio. Buy more of the dividend-paying shares, or buying the stocks with high ROIC, or the stocks with the history of stock buybacks. And since you made it this far in the video, here's a nifty trick called the Rule of 72. It's like a financial crystal ball that can predict how long it takes for your money to double. All you have to do is divide 72 by your annual interest rate. Simple, right? Let's say you have an annual return of 8%. 72 divided by 8 equals 9. So, in approximately 9 years, your money will double. Remember, you need to do your own research and due diligence before investing in any company. You need to understand the business model, the growth potential, the competitive advantage, and the valuation of the company. But that's it for today's episode. I hope you enjoyed it and learned something new. If you did, please hit the like button and leave a comment below letting us know what you learned. Thank you for watching, and I'll see you in the next episode.